Retirement Report. I'm Hank Parrott, your host. You know, I was talking to you a little bit about inflation, and we're going to get back to the market discussion as well and different strategies. There's a great chart, historical rates, inflation rates rather, from 1940 to 2020. And this is one of those when as I was talking about the difference of when we see rates up this high, to kind of give some perspective that it's not that the sky is falling and everything's gloom and doom, right? Or that this is going to be somehow a permanent thing. When we look back, in fact, in 1974, inflation ran, again, double digits, around 11%. We know it was quite high during the 1970s and into the 1980s, or the beginning of the 80s. In fact, the three really bad years in a row. 1979, inflation was running at 11%, 1980 at 13%, and 1981 at 10%. I don't think we're in for that kind of a period where it's going to go that long. I think one that, and it was Volcker, by the way, that ended inflation then by aggressively raising interest rates. And was what we're kind of seeing right now with the Fed is them doing that. We just hope they don't overshoot the mark and get us into a recession similar to the early 80s there. Now, following that, we had a very prosperous period, and we had some of the lowest inflation rates here over the last 20 years. And this is an area, when we look at inflation historically, it tends to, when I do projections, for instance, on the reports that I talk about, I typically use 3%, because historically it's been under that as an average. So what we want to think in terms of, again, when you're planning for your retirement, okay, and you're in your 60s, early 70s maybe, I mean, you're looking at, I mean, some may argue this point, but typically about 20 to 30 years at retirement. People are living longer. It's one of the things in going to conferences, and I don't know, Jeremy, if you've had much experience with this, but I know conferences I'm going to now, one of the big topics they talk about is longevity. People are living longer, so when we're planning and helping people determine how to invest and how to set up a financial plan for life, we're and in particular in retirement, we're looking at 20 plus years in retirement. I mean, it's 20 plus years without a paycheck is an example for many people, and how to plan around that. You got to be thinking more long term than ever before.
Absolutely. And Hank, look at the amount of people that are living well into their hundreds, and we see them on the news. And, you know, I think the average life expectancy of people is going well into their mid to late 80s, even early 90s. So your money and your dollar in retirement has to stretch longer, and it has to be sustainable, especially in an inflation environment. Historically, 2-3% inflation is normal. So it's really important to utilize strategies to stretch that dollar out longer. And Hank, if you have a client in retirement who might be over allocated to equities or an aggressive sector, and they take a 20-30% hit to their portfolio, especially in retirement, and we have a slow market recovery, that client is not going to stop taking money out to live. So that's going to be detrimental to their portfolio, and they're never going to recover from that. And they have a great risk of running out of money in retirement. So it is crucial for financial planning right now and utilizing strategies for longevity, guaranteed income, and risk management on your portfolio.
You know, more than ever, and this is one of those areas, as we're living longer, and as Jeremy said, when what you're looking at is the typical risk that we have to deal with every day, whether we're talking interest rate risks, of fluctuations there, of course, stock market risks and the volatility that we deal with there. When you're inflation and the effects of, the longer the term, the longer we live, the more these risks impact us. And then there's one that Jeremy alluded to called sequence of returns risk. And what that means is if you're investing in retiring rather, in a down market, right? And the market's going down, and we don't know for how long. Maybe it's just a year, maybe it's 2 or 3 years. So when that's happening, how do you plan? If you're, as I've talked about before, when you're saving your money, when you're putting money into your retirement accounts and the market goes down, not such a big deal, because every month or every pay period, I'm still making my contributions to my 401k. The shares that I'm buying, whether through mutual funds or individual stocks, those shares, right, if the price of those is going down, that means I'm getting more and more shares for the same money. And those shares right now are undervalued, meaning they're selling for less than they're really worth. So when that goes back up, if I've got more of them, I'm going to benefit from that tremendously. It's in fact a strategy called dollar cost averaging, which is about smoothing out volatility and improving returns over time. And this is kind of what we're doing, or exactly what we're doing when we're saving for retirement. In retirement, when we start taking money out and the market's going down, what's happening? I need to maintain a certain amount of income, right? Well, to do that, if the shares that I'm selling are dropping in value, dropping in price, I have to sell more and more shares to get the same amount of money. And that puts me in a position to potentially run out of money. And this is what we call sequence of returns risk. Tony Robbins, in his book, Money Matters, did a great job, better than I did in my introduction on my book. In terms of, he had a great example showing two investors, each taking out 5% in retirement, and how one ran out of money 20 years or less than 20 years into retirement, and the other one had multiples of dollars over the first. Why? Because when they retired, one retired into a bear market, one retired into a bull market. We don't know, right, what's going to happen. We don't know if this market's going to turn around quickly or if it's going to be drawn out some. What we do know, though, is that either way, we need to be planning for whether the market goes down or the market goes up. We have stable income increasing over time. I'm going to explain how to do that right after this break. Join us here. We'll be right back on the Retirement Report.